Hi, my name is Loren Francis, and I'm with Highview Financial Group. At Highview, we have a keen interest in impact investing. And for complete transparency, we do have an investment in the Rally Total Impact Funds. Today, we're here to talk about impact and the difference that it can make. And I'm first going to start by asking Mark. Mark, perhaps you could tell us a little bit about the Rally Total Impact Fund.
Thanks, Loren. So the Rally Total Impact Fund really exemplifies the word total in many ways. It's total in that the impact we're looking to generate is to target all the SDGs. And so those are the United Nations Sustainable Development Goals. And so we're looking to that on a very balanced way. Also, we're looking to do that across the world, not just within Canada or North America. We're looking for a truly global approach through global investments. And finally, and interestingly, I would add, we're a fund that takes a multi-asset class approach. And it's quite different than the balanced approach investors are familiar with, where there's some public equities and some public bonds. We're actually looking at it much more holistically. We have private investments in the fund as well that really offer very specialized, deep and targeted impact opportunities. And we're able to provide access to investors to be able to participate in those, in that balanced portfolio content. Now, it's a total impact fund, but it's also a returns-focused impact fund. So we're looking to balance as well impact and also generate attractive risk-adjusted returns for investors.
I do know that Rally is very much aligned with the SDGs, the Sustainable Development Goals, and you've taken those 17 goals and you've really put them into 5 investment themes. And today we're going to talk about a number of those, as we have with us today Shalli Shankar from AiiM Partners, one of the investments in the Rally Total Impact Fund. So perhaps, Mark, you could just start with talking about those 5 investable themes, and then we'll start digging a little bit more into the AiiM Partners Fund.
The reason why we created 5 themes around the SDGs is, the SDGs are fantastic at letting us know, here's what impact is needed. But what they don't tell you is, where should you direct your capital in order to affect that impact? And so the themes that we've created, and they're themes that are different than I would say investors, when they think of thematic investing, might have come to mind. They're not sector focused. They're action-oriented focus. There's an action and an outcome we're looking to achieve. And so our first theme, being basic needs, is really targeting those basic needs that are required for everyone to have a life, a sustainable life. And those that don't have access is where we're really looking to focus on providing investments. Empowering those that have been structurally excluded holds a whole host of social equity issues, be it gender focused, disability focused, age focused, race focused. We're looking to address those structural inequalities within that part of the theme. Addressing climate change, and of course, a very popular area with investors today, is something that we're looking to do. And we're looking to do it beyond, call it the obvious areas of just renewables and energy efficiency within buildings. We're looking for a very holistic approach within that theme. Our 4th theme is natural capital, and that's focused on all the areas of the planet that don't necessarily directly tie to climate change, but are certainly part of the overall ecosystem. And social infrastructure, our 5th theme, is about making sure that all of society has equal, fair, and just access to what I would call essential resources. And so it's kind of interesting, because you're asking me about the SDGs, and we have Shalli from AiiM here, and this is one of those interesting investment opportunities that covers almost all the SDGs and all our themes, particularly on climate change and natural capital, but also in empowerment as well. And bringing all those into one investment mandate, and actually showing that there's quite an interrelation between the SDGs.
That's terrific. And I'm excited to learn more about AiiM Partners. So Shalli, maybe over to you. You could give us a little bit of background on AiiM and how AiiM came about, perhaps, and then what it is that you focus in on.
First, thank you for having me over today. And I am the founder and managing partner of AiiM Partners. Our team has been doing climate tech investing for almost a decade, even before it was hip. So we've seen the surge of interest and assets and how that can transform a space in sometimes very, very positive manner. So we, as a fund, invest in technology companies that are addressing the overlapping issues of climate change and access and equity. We have very measurable and quantifiable goals. We are targeting top tier performance, financial returns for our companies. But in addition to that, we have very strong criteria on how we would measure our outcomes for climate and for access and equity. For example, we hope to offset a gigaton of greenhouse gases through our investments by the time of the end of the fund life. We are at 0.8 already gigatons, so we're very excited about that. That's how the fund is shaping up. We hope that at least 50% of our portfolio would be invested in companies that have women and people of color in senior leadership. And currently about 60% of the assets are with companies which do meet that criteria. And we seek to provide capital in the missing middle. In the early life cycle of a company, there's a lot of capital, philanthropic capital, startups, incubators that give them funding. And then as they mature, once they're profitable, then there's a lot of really large funds waiting on the sidelines to invest in them. We invest in this missing middle where we feel that the capital is limited, especially for companies that are solving some complicated climate change ideas. And especially if those women, if those companies are led by women or people of color. So that's been our focus so far.
Maybe you could tell us a little bit about a couple of the investments that you have made. That would be really neat to hear.
Sure. So our focus is to invest in underinvested sectors and to invest in underinvested talent. So when it comes to sector investing, very much like Mark said, that about 60% of the capital has gone in climate change to sectors like transportation and so many other sectors where so much interest has gone. However, 80% of climate change related damage is done by the remaining sectors. So that sector is underinvested. And to give you an example, one of the sectors that we were really interested in evaluating is materials manufacturing. Now, this is about a $2 trillion industry, and it accounts for about a fifth of our global greenhouse gas emissions. And for the last 6 years, this sector has received less than 6% of overall climate technology funding. It's not a very sexy sector. It's not very exciting, but it is it's core to a lot of big problems in climate change. So from climate change perspective, we were looking for companies that had the potential of low carbon alternatives. And also packaging is the single largest producer of plastics, which is one of the biggest components of these greenhouse gas areas. And those typically end up in our oceans, they end up in our waterways and in landfills. So from that aspect, we invested in a company called Ecologic. They were replacing plastic bottles with bottles that were primarily made out of recycled cardboard and paper. We looked at them for a number of reasons. It was led by a very amazing founder. She had left her career in investment banking to form this company. But one of the reasons we liked the company was they were based in Central Valley, California, which not only had unemployment issues and a whole lot of other issues, but we loved the fact that the company was not only employing people who were previously unemployed, but a large percentage of women on the manufacturing floor, even for their night shifts, was women. It was just an interesting anecdote that we heard from them. But anyway, they were very recently acquired by Jabil, which is a publicly traded company. And what we like about that exit is that from impact perspective, they could have raised capital, gone on for another few rounds, but now suddenly they've been acquired by somebody who has got 100 locations and is growing this product in phenomenal space, and also being able to add additionality in terms of what the next decade looks for.
So, Shally, I find it fascinating that a lot of the companies that I look at in your portfolio are just things that, people, as you mentioned, don't really think about. I mean, the use of mycelium and a fungus, for example, as material substitute. The question would be, how do you find these type of opportunities? How do you locate them?
The credit goes to my amazing team. And I think our strategy is that once we have identified the sectors which are the biggest problem creators, then within those sectors, we look for technologies that could potentially solve a big problem. And then even for those companies and for technologies, we see, are they at a tipping point? Are they getting to an inflection point where either there is consumer need, willingness to pay, or the incumbents are looking for solutions? So we spend a lot of time to see if the company has actually, or a technology has actually entered an inflection point. And that was the reason that we invested in Atlast a few years ago. We felt like there was so much money going into plant-based foods, and an alternative to proteins. Traditional animal-based proteins is one of the priorities for us, given its greenhouse gas impact, as well as something like bacon. In the US, the statistics is that 50% of our rivers are polluted with runoff from hog farms. So bacon is a big problem for the world as well as the US. And this company was coming up with an alternative to bacon, which was fungi-based or mycelium-based. And one of the reasons we invested in this company is because a number of investments that were going into plant-based was nothing compared to what was going into fermentation 2 years ago. This year, I think investments in fermentation-related technology companies is going to exceed plant-based, but 2 years ago, that was not the case. We also like that the team had a 10-year track record of building products and services and had know-how. And the last aspect we spend a lot of time on is the team. Technologies change, especially at earlier phases, but we spend a lot of time getting to know the team and see, can they actually pivot and do the right thing in terms of scaling up the technology? What are their biases? What are they looking for in outcomes? And we found out that from the beginning to the end, product changes, and there are so many iterations, but if the core of the company is aligned, we've had a lot of success in those companies. And I think the core of our work is to make sure that our technologies are solving problems for the 99%. So from that perspective, we place a lot of emphasis on the end unit cost of the product and want to make sure everything we invest in is at cost parity by 2030. Otherwise, we don't think it's going to get to the global south and other countries that we care about.
I know we need a lot of capital still to come into the sector, particularly impact. But are you seeing the change starting to happen, starting to occur, where there's more interest and more capital becoming available? Are we going to be able to make really a difference in terms of impact going forward?
We have currently 3 companies in our portfolio. They're raising between $100 to $250 million. They're on path to solving a big problem. They could not have dreamt of going to market this quickly, but there is actually interested capital, aligned capital. So we love the amount of capital that's come into the space, because it's letting these companies actually be able to hire faster, grow faster. And suddenly there is realization that climate change is not a software play. So I think from that perspective, people are getting a lot more comfortable writing checks into companies that will use it for the C word, CapEx, and we see a lot more people getting comfortable with that. And I think that's going to be the tipping points. And I think that's why it's been good to have the really large investors come in, because a lot of them coming from private equity do understand that this space does need CapEx as well as a lot of physical and people assets to grow.
Can you talk to us a little bit about how you actually measure the impact of your investments?
We measure it on 3 levels. So one is climate change. So every company we invest in, we do our independent analysis of the impact it'll have on greenhouse gases and biodiversity. We have researchers, scientists, and data scientists that we work with, whose role is to help us make sure that before we make an investment, we are not going to make any unintended negative consequences on the environment. So from that perspective, we have a point of view internally before going to invest in a company. After we invest in companies, we work very closely with them to make sure we understand their growth trajectory, where they're going. And we're finding out a lot of companies are too busy, or they're not at a point they've had a chance to sit down and calculate their own greenhouse gases sometimes. So that's a role we play with all our companies very proactively. And it's symbiotic, because we get to learn so much about their business aspirations and their growth and their scalability. And on the other hand, we have the in-house expertise that we're able to share with them and partner with them. So climate change is one. Biodiversity is the other factor that we spend a lot of time measuring. So for climate change, measures like greenhouse gases are tangible, measurable, even though we have to do it company by company, we can do it. But biodiversity is the challenging one. And this in coming year, our priority is to come up with metrics around biodiversity that we can disseminate and share with our colleagues in the industry. And the third area that we spend a lot of time thinking about is inclusion. And from the day a company comes into our pipeline, we spend a lot of time making sure that no company is very unintentionally screened out for a standard criteria it may not meet. So every company is looked individually, and we are making sure very proactively we are not screening out deserving candidates, irrespective of the background, irrespective of the composition of the team.
When you look at the investments that you hold in the Rally Total Impact Fund, how do you look at measuring the impact of each of your investments?
You really have to use a combination of data, so quantitative information and targets, but you can't be exclusively data focused to think, well, that is going to lead me to what's going to be impact. There are intangibles, there are fundamentals, there are the people that are involved. And so taking a quantamental approach in terms of ascertaining that impact is quite important. And we're seeing this, and it has been actually a learning for Rally as we've gone through the years, is that the intersectionality of impact is quite strong, right? Like good companies do good things across all the things. And you know, when we sort of look at more traditional funds, they're very narrow focused. Let's focus on just climate change. Let's focus just on racial or gender issues. And we're seeing that instead coalesce. And those businesses, frankly, that have multi-dimensions of impact rather than just a narrow focus also tend to be our best performers as well from a financial standpoint and from a risk standpoint. They tend to be more rigorous, more dynamic, and more successful.
Well, it was wonderful speaking with both of you today. Thank you.